Hey, hello, Mavericks. This is Rob Reinhold. It's nice to be here. And we're going to be talking about bear markets. All right. Now, I started trading in 1997, and it was in the middle of a bull market. And I had only really learned about being long stocks. And then when I learned about being short, I thought it was the coolest thing in the world. And I fell in love with shorting. I absolutely fell in love with it. And for the first couple of years, maybe even longer, I was definitely more of a bear than a bull. So I love bear markets. When bear markets come, I feel great. I feel energetic. I feel like, oh, this is the opportunity I've been waiting for. Now, this is going to be different than a lot of you who are more bullish minded, who bear markets kind of scare you and terrify you, and you say, hey, I don't really know what to do here. In the end, it's all just market movement. However, bear markets come with volatility. They come with volatility, and with volatility comes emotion and panic and fear and all the things that really drive prices to move very quickly. So, we are ambivalent to whether things go up or down. It just doesn't really matter. We do know that when they go down at a much faster velocity than when they go up. So let's go ahead and kind of get started. And I want to just kind of go through the big picture. And this is going to be a lot of economics. For any of you who have taken any economic courses, this is just economic theory 101, is market cycles. So markets go in cycles. And the four classic cycles in economics are your early phase, basically coming out of a recession. You have your early phase, and then markets get mature, and you've got that late upswing phase. And then the economy starts to slow. Things slow down a little bit. People start to cut back a little bit. And then all of a sudden you get into recessions, and you get all the things that happen in recession. Lots of layoffs, lots of low consumer sentiment. Everything is low. The stock market bottoms out. And then at some point, it stops getting terrible, and it goes higher. Now, this slide here is a very classic slide. This is the slide of market cycles versus economic cycles. And basically what it says is that the markets follow the economy. Actually, I got that backwards. I didn't get it backwards on purpose, but I wanted to get it backwards. Economic cycles are led by market cycles. So the stock market is it's called a discounting mechanism, meaning that it prices out where it thinks the economy is going to be 6 to 9 months in the future. So market cycles are typically ahead of economic cycles. You'll see the stock market come down before you see economic growth start to come down. And you will see the stock market goes up well before the economy ever reaches what is considered a bottom. So these things do move hand in hand, but the market cycles are always first. They lead the way. Absolutely. So you can see here, right up top, we've got all of our sectors. Basically, it tells you what sectors typically do the best. So let's just take the top of a market cycle. So at the top of a bull market is right here. Energy and materials are typically doing the best. Why? Because one of the hallmarks of a late stage rally is inflation. And inflation is very good for energy and basic materials. This is where, again, there's been a lot of building, there's been a lot of expansion, and so the pressure on commodities is usually pretty high, and those things do the best. You can see that once the market tips down, and again, and it's well ahead of the economy, which is in the green here, you can see that consumer staples, healthcare, and utilities actually start to do the best. And if you want to take a look at the very bottom of the market, over here on the far left here, cyclicals. Cyclicals typically, financials and cyclicals and tech typically lead the way. Now, we see this all the time. I've had the pleasure of having this be my profession for the last 25 years. So I've gone through three of these economic cycles. Basically, the market top in 2000, the market top in 2008, and then the market top in 2020. So what we want to do is we want to go through kind of what happens. Now look, this is natural. This is natural and normal behavior. This is how economies work. This is how human beings work. And again, human beings are the economy. So this is really about human nature, is that when people are optimistic, when the economy is doing well, they tend to spend more. They tend to overextend themselves, and businesses tend to build out too much. And again, it's all these cycles of growth that at some point there is a top. So we take a look back all the way back to 1945. I really want to focus on this column right here. Now, this is the months in duration of a bull market. And this is the growth in employment and the growth in GDP. But I really want you to focus on the months of duration. So we had 37 months. So basically that first one was about 3 years of expansion. And then came a recession. And then that recession lasted, it looks like, about a year. And then we had another expansion of 4 years. And the next recession lasted about a year. Then we had another expansion of 39 months. And again, this next recession looked like it was only about 6 months long. We had a 2-month recession and then a 2-month expansion followed by a recession of again another about 9 months. And then look at this one, 106. So this was an 8-year expansion before actually going into recession for another full year. The point is, it's cyclical. These are all cycles. And at some point, we actually will have a recession. This is just what happens. It's a guarantee, and it will always happen this way. This last one, June 9th, 2009, through outgoing, that actually ended in 2020. So February of 2020, that ended. And that was actually the longest expansion, 11 years, beating the expansion from 1991 to 2001. So the first thing I just wanted to get out of the way on this is that this is natural and normal. And when you get into the world of trading and investing, you have to know that these are coming. Now, I say that, but people are surprised all the time. And what happens is people get in, they start investing in the market, and they usually start investing in the market after the market has done very well for a long period of time. They get in, and then they don't understand that, hey, these market corrections and crashes happen. So what I want to go through is the 3 things that will happen in the cycles of an uptrend. During trends, I should say in all trends, in downtrends, we have the same thing. But I'm just going to talk bullish here for a second since we are talking about bear markets. Pullbacks. So what a pullback is, it's defined as a 5 to 10% pullback. So the market has a deep enough pullback that it actually causes some pain. But it's just a pullback. It's not anything major, and it typically lasts, anywhere from, probably 3 to 6 weeks. Then you get what's called a correction. Between 10 and 20% is considered a correction. Now, these corrections, these cause even more pain. And these typically take 3 to 6 months for, even in an uptrending market, for them to work out of and to get back up to new highs. Now, these are very natural and normal. But then, every so often, there's going to be a market crash. So I'm going to pull up a chart here of the market all the way back from 1990. And this, I did it right before the pandemic hit. But I want you to take a look and see all of these red little circles here. These are all of the 5 to 10% pullbacks. Now, we're going to get into how often these happen, but you can count on every, I'll get the actual data here for you, but you just have to count on that you're going to get 1 or 2 of these every year. It's just going to happen. So you can't be surprised when they come because they're going to happen. This year, whatever year it is, I can tell you there's probably going to be 1 to 3 of these pullbacks somewhere in the year. Then we go into corrections. So as you can see, over the past, 20, 25 years, we've had a total of about 10 or 11 corrections. Okay, so these corrections, now these were definitely more painful. These are 10 to 20%. Very, very painful. And then bear markets, you can see we had 3, and then there'll be 4 here at the end. So again, 4 bear markets, greater than 20% declines. So let's take a look at the actual numbers here. All right, so if we take a look at pullbacks. So the average, every 10 and a half months, there is a pullback. And the average pullback is 7%. So some are going to be 5, some are going to be 9. So again, you have to consider that this is going to happen at least once a year, if not twice. The average correction happens about every 12 months. All right, so you're going to get 1 to 2 pullbacks from 5 to 10%, and once a year, you're likely going to get a correction. The average decline is 13%. You just have to go into every year just considering this is pretty much going to happen. This is how markets work. This is how economies work. It's going to happen. Next, bear markets happen every 3.6 years. There's been a total of 32 bear markets since 1900 for an average drop of 34%. All right. Now listen to that. And this is what people don't understand. The average is 34%. Now this is the one where I just think people don't understand what can happen. And look, and I'll be honest, I didn't understand what could happen until the dot-com bubble burst in 2000. And I remember the stock market was down like 10, 15%, and everyone was saying, oh my gosh, it's such a good time to buy. Look how cheap everything is. Things were decimated well past that. And most of the dot-com stocks lost 90 to 100% of their value. It was really brutal, and it was really eye-opening for how bad it really, truly gets. 34% is the average drop. Now, the average recession or the average bear market lasts an average of 15 months. So in your lifetime, let's say that you have a 50-year trading career. You're going to see a lot of stuff, and there's going to be some periods in there where you are in a long-term bear market, meaning that there's going to be a market that drops in value for 15 months. So this is where we always say, look, you have to learn how to trade all sides of the market, long, short, sideways, because as long as you're a trader in this profession, this is going to happen. So you do need to understand and be ready for this. So those are the numbers. So the big question is, how do we know which one? So we know these are going to happen. We know they're a guarantee. When they happen, how in the world can we know which one is the correction or the pullback and which one is the crash? Now I'm going to start off with one of my favorite quotes. Warren Buffett. He is one of the best quote makers ever. You know, there's some people that can just talk and they just say things and you're like, that should be quoted forever because everything that comes out of their mouth is just so clever. This is one of my favorite ones of Warren Buffett talking about recessions. Only when the tide goes out do you get to discover who's been swimming naked. And basically what he's saying is only during a recession do you get to see which companies are doing it right and which ones aren't. Because when the water's high, when everything's going great, you can make a lot of mistakes and it gets covered up by the economic activity that's so big that all your mistakes it doesn't matter. But when the water goes out, you get to find out which businesses have enough cash in the bank to weather the storm, which ones have the best management to be able to stay in business. And that's what happens. And again, you should actually be really happy for market crashes because what they do is they actually reset everything. As the economy grows, we get more people at, I always like to think of a pie here. You know, there's a pie, and let's say that there's 10 companies that made it through the last recession. So again, when in the recession, that pie got smaller, economic activity got smaller, and there was 20 companies before the crash. Now there's 10 after. Now when the pie starts to get bigger, there's only 10 companies that are eating that pie, which means that those 10 companies are going to be highly rewarded for surviving, for doing it right the first time. And they make a lot of money, especially in those first couple years. And then what happens is new players come back in, and pretty soon we've ballooned up to 25 companies. And it's too many. There's too many companies, too much competition. And then as soon as the pie shrinks again, we go through the same thing. So let's talk about just some economics. And let's talk about correction or market crash. Now, corrections are normal. They're natural. They're going to happen once or twice a year. What we're going to see is the technicals hold up. So I got down here, rarely breaks, long-term support levels. All right, so let's talk about some of these longer-term support levels. Things like a 200-day moving average would definitely classify as a long-term support level. Maybe like a 50-period moving average on a weekly chart would be something that qualified. So you get these pretty sharp pullbacks, but when you take a look at the long term, you still have some very good technical levels. Also, you typically see good economies and good economic growth. So these are typically seen in good growth areas. So they're quick to recover. And that's another thing. They're quick to recover and they get back up fairly quickly. On the other hand, a market crash, it basically is where you have a real change. And something typically is the catalyst. And let's just take the most recent one we've seen is March 2020. There was an absolute catalyst. There was an absolute something that came in and changed it. What changed? Well, we had a pandemic that slowed economic activity down dramatically in a very short term. Now, that market crash was the shortest on record. We only were, that was about 6 weeks of down, but it was brutal. It was 35%. So these things typically happen off of some event, and they typically happen after a long period of expansion or a market bubble. Now that is the key here, the market bubble. So if you go back through all of the last, let's take 5-6 recessions or 5 or 6 market crashes, we're going to see that everything except for March of 2020 was a bubble. A bubble preceded it. Now again, a bubble means that asset prices get elevated, much past of normal valuations. So let's just take 2000. Let's take the stock market run into 2000. The S&P 500 typically trades around 18 to 20 PE. That's price earnings ratio. In 2000, it was trading at a 35 PE. So when you take a look at historical measures, you take a look at long-term historical trends, you could see that was absolutely overvalued. Now, I believe it was back in the 70s or 80s, the lowest it got to, with the S&P got to an 8 on PE, which is historically undervalued. And it ended up being a very good time to invest in the market because it was traditionally undervalued. Let's also take 2007. Now, we had 2 bubbles in 2007. We had the housing bubble, and we also had the oil bubble. Now, everyone remembers the housing bubble. People have forgotten the oil bubble. But oil went to $150 a barrel. And everyone was investing in energy stocks. Everyone was throwing as much money as they could at energy because it was amazing how high the prices have gone. It got to the point where both in housing and in the cost of fuel, it was way past historical norms. So that's a market bubble. So the easiest way, in my opinion, to really look at the current situation and say, okay, the market's in trouble here. The market is falling. Okay, you go down the list and say, what were the conditions before this? did we have excess valuation in assets? And this, again, this isn't foolproof, but this is the first question you should ask yourself. If the answer is no, then it's probably a pullback or a correction. Again, we're going to get deeper into this, but this is the first question to ask. If you had market excesses, then you have to be on heightened alert for, this might be more than a pullback or a correction. This might be the one. This might be the crash. That to me is the very first thing you look at when you're trying to answer the question, is this the market crash? The first question is, was there a bubble before this? If the answer is yes, I think you need to be very, very open-minded to this is a market crash, not a pullback. If the answer is no, then I think you have to be, first of all, starting off with, okay, this is likely a pullback or a correction. Now, here's the great thing about being a trader. We're small, we're fast. We can change our minds. So, following technicals, when things start to break down, we can go bearish. Now, we don't know. We have no idea if this is a pullback or a correction, but we know the technicals are telling us to be bearish. So we get bearish. And if it turns into that it wasn't a pullback, that it was more of a correction, guess what? We're already there. We're already there. But let's say it was a correction, let's say it was a pullback. We got short. It was very short and brief, and then the market recovered, and we say, okay, looks like we were wrong. Let's take our small loss and let's get back to being bullish. That's the great thing about being a trader. You don't have to make these long-term stands of, I know this is right, I know this is wrong. No, you just say, oh, okay, I thought it was going to be a correction, but I was wrong. It was just a pullback. Let me get back onto the right side. If it wasn't just a bounce and it was a correction, you were already short. You are already following proper technicals. And if it ends up being a correction, it bottoms out at 13% and it rebounds back up. Yeah, hopefully you made some money on that bear move. And if you didn't, you take whatever loss you had and you move on to the next cycle to the upside. But if it was a bear market, if this was the one, you were already short and you can just stay short. So again, the technicals are going to keep you in the right place. So follow the technicals all the time. So let's take a look at a couple of things here. So market extremes. So what we want to do is we want to take a look at, are there extreme readings? Now, if there are extreme readings, it becomes much more likely that this is more of a market crash than it is just a correction or a pullback. So what we want to do is we want to take a look at some of the indicators, say, okay, do we have extreme levels? So I'm pulling up here what's called the ADX line. This is not something I look at on any sort of a regular basis. And really, going back in history, you get about maybe one signal a year. And basically what it's just saying is, hey, at this point, above 40 or below 10, it's really a scream that says, hey, things are getting a little crazy, either too optimistic or too pessimistic. And that's all this is really saying, above 40. So let's take this big spike here in 2004, and we can see that pretty much told us, hey, there's going to be a little move down. So when we get these big peaks here, it's telling us, okay, we've reached extreme levels. Now, it also works on the downside. We get extreme readings down here at 10. It's telling you, hey, you know what? This is likely a good time to go in and buy. So it's just telling you extremes. And that's what you see. When we see these movements, whether it's a pullback, whether it's a correction, or whether it's a bear market, we tend to get these extreme readings. And these are going to tell you, okay, what do we need to look for? What do we need to see? Right, so to kind of wrap this up, and then we're going to go into some more detail here. You have to know it trades in cycles. You have to know that it's going to repeat themselves. You have to know that once a year, you're going to get a correction. Once a year, you're going to get at least a 10% drop in the market. If it is, and this is where I don't want to get you too paranoid, but there was a period of time, and I want to say it was in 2007. I can't remember if it was 2017. It was either 2017 or 2019 that the market had gone the longest period it had ever gone without a 10% correction. It was something like 19 months. Now, when you hear those things, you have to be thinking not, oh, it's never going to happen now. You have to be thinking, oh, it's more likely to happen. You should be heightened to be watching for those. It just happens. They just happen all the time. So understand that every year you're going to get these movements. You're going to have a period of time where there's some severe distress in the market. Once or twice a year, severe distress. Don't try to time those. Those are very hard to time. And a lot of people try to time them. What we do is we say, hey, look, let's just stick with the technicals. Let's just stick with the moving averages and the slope of the moving averages. And when the slope of the 50-period moving average is going lower, it's probably time to be really defensive on the bull side and be very aggressive on the bear side. And when it's above the 50-period moving average, let's be more bullish and bearish. We don't need to try to get the tops and bottoms. The tops and bottoms are very, very tough. And if you do try to do tops or bottoms, you're going to be missing a lot of big trends. And that's where the big profits are made, within the trends. All right, so let's jump into just some charts here. All right, so I'm going to just go ahead and play around here. It is February 17th, 2022. And I just want to kind of throw in some stuff. So let's throw in the ADX. Let's throw in the ADX and kind of see, okay, where are we here? So I'm going to go out to a longer term chart and just kind of show you when we hit extreme readings. Now, you can see here on this ADX, we have not hit above 40. So 30, 35s are our peaks. But here we go back to May of 2021. May of 2021, it says, hey, you need to start being cautious. And sure enough, we got a move down from 4,200 down to 4,050. That was about a 5% pullback. Here we get a reading here, and you can see that this reading wasn't as good. Very, very minor pullback here. So again, it's just telling you this is where you start to get at least thinking to yourself, okay, I need to start really considering that there is a big pullback happening. So we got to move from 4,730 down to 4,500, about 230 points. So that was about a 6 or 7% pullback in the market. So as you can see, and again, I challenge everyone just to go back in time and take a look at these things that just happen over time. And I'm going to larger time frames because I want to see some candles here. So here's a monthly time frame. Just take a look at how things move. So again, here we had a very extreme reading on the ADX. Again, this is ADX. You could pull up RSI. You could pull up almost anything. And it would tell you, hey, we're reaching extreme readings. We had a very big extreme reading here in 1987, preceding the big crash of 27%. That's a big crash of 27%. You can see here, the extreme readings are what you really want to look out for. If you say, Rob, I don't do ADX, but I do RSI, great. You could also be taking a look at the RSI. And same thing, extreme readings. You want to be cautious of extreme readings. This is typically the point where you can get the big moves. So we got an extreme reading in 2007, preceding the market crash of 2008. We got extreme readings, but again, we got them back in 1996. And this is 1996. This is where Alan Greenspan made his famous speech of irrational exuberance. Irrational exuberance. The market topped out 4 years later after really every extreme reading. So when you're using these, you can't just go off of these extreme readings and automatically go short. There are proper technicals that we always follow. Again, we have to see daily charts below a 50-period moving average that's moving lower to really really give us a signal that it's time to go aggressively short. Take a look at this last expansion. Take a look at where we are here. This is where I wish we had the benefit of coming back 2 years from now and looking at this. And here is the great thing is that we're recording this live, but this is going to go up as a video on the website. And you're going to be able to go back and look and see, oh my gosh, we can see it now. It was very hard to see it in 2008, 2011 when we had a big pullback. Nobody saw COVID coming. I'll tell you that right now. That was one you could have never seen. But you could have seen that we had very elevated prices. And whenever you have elevated prices, it tells you it's more likely to have a big drop in markets. So here we are, February of 2022. We've already had about a 10% correction. Now on the CNBC, I've heard people saying, oh, well, this is a deal, this is a discount, this is a bargain. Now, yes, we did have our last technical bear market in 2020. Typically, the average recession happens, I think it was every 5.7 years. So theoretically, this would be, if we went into a bear market here, this would be a very, very small window of expansion, about 22 months. About 22 months is all we would get, which would be one of the smaller ones. However, preceding this, we had our longest one of 11 years. I'm a big believer in reversion to the mean. If the average recession happens every 6 years, and we had 11 years without a recession, and then we had a recession, it would make sense that the next recession would be off of a shorter expansion. Look, I have no idea what's going to happen. We have no idea at this point. But I can tell you what, everything is set up. We have elevated levels. We have an RSI that's very high. We had a big run. Valuations were extreme in the S&P. I don't know what will happen. The economy may recover. But as far as right here, right now, it is now a correction. It is now officially a correction. We got down to 10% here. Here's the great thing. We don't know if it's going to be a correction or a market crash. But what we do know is that the technicals have turned. We have moving averages falling. We have lower lows, lower highs. We're already net short. We're already riding more bears than bulls. We're already trading in a way that would be risk off. We have no idea where this market's going to be in a week, 2 weeks, 2 months, 2 years. I have no idea. Because of that, we just have to trade the market in front of us. And right here, right now, the market is saying it's going lower. And when we go to longer term viewpoints, we are coming off extremely high levels. We have extreme readings all over the place from last November and December. This absolutely has all the hallmarks of a possible bear market. Now look, it could not be a bear market. We could go down 12, 13%, and that was it. And we come back and we look back in history and say, okay, well, that wasn't it. But we'll see. We will see what happens. But the great thing is when you understand all these things and you understand how it works, and you already go into this market thinking, okay, this is how market cycles work. I am fully prepared and ready for a long-term bear market. And it doesn't really matter because I'm just going to follow the technicals. We have bearish technicals here. And as long as we have bearish technicals, I'm going to stay bearish. And whether that is for a 10% pullback, a 15% correction, a 25% bear market, whatever it is, I'm just going to follow the technicals. That's the biggest thing I wanted to share with you in this session, is just to understand that this is how markets work. You have to understand that there is one period every year where the market gets severely tested, a correction. 10, 15%, and it's brutal and it's bad and everyone is losing their minds and margin calls are going out. It happens. Just be ready for it. All right. Well, that's really all I have for you. If you are watching this in the future, we'll see. We'll see what happens. But we do a year in review video or a session every single year in the 1st of January. And this January, I came out and said, the bubble is popped. It is popped. Last year, I said, we're in a bubble, but it's going to get even bigger. And I said all year long, the bubble's getting bigger. Still go long, still be long. My call this year was that the bubble popped. And we're definitely seeing it in the first part of the year. We'll see what happens throughout the rest of the year. Hey, thanks for joining me, everyone, and take care. Goodbye.